Hi, this is David with the Algo Trading System, and today I would like to touch on a video that I previously made titled 8 Mistakes in Algorithmic Trading, where I made a list of what I consider myself to be 8 common mistakes that I made myself and that I've seen others doing when approaching algorithmic trading or systematic trading in general. And at the time, the list was, well, the first one is data snoopy bugs, which means when the practical application of the code is somehow able to look into the future and execute a trade on data that normally wouldn't be available in real time. And the second issue is using a short time span for testing, so maybe using only a few months or 1 year. The third was using a small sample trades, so only maybe a few dozens, so 100, 200, which I consider to be still a small sample. And then ignoring trading fees or using excessive stop losses, building overly complicated algorithms because it can lead to overfitting, and evaluating an algorithm just by profit or by some other very simple metrics that don't take into account issues like volatility of profit, and then building a system with no variability, so one that is only built on a set of indicators, set of parameters, and then to be used pretty much forever. So in this case, I would like to do a review of some videos that I found on YouTube. And this is meant to be constructive criticism. I don't mean to get specifically on the case of anybody in particular, but I stumbled into these videos. It was between the suggested for me on YouTube. And what happens here, basically, the author of the video will either present a strategy that he builds himself or review somebody else's strategy and do, I guess, a manual backtest of 100 trades. So I guess here is a table of one of the potential, one of the results of one of those strategies that are shown. So here I think there is some red flags that I would like to highlight. One would be the first, and I guess one of possibly the most important, that it's only 100 trades tested. So to be fair, the author always says, remember, you should do your own testing. This is only 100 trades on a single market, and that's valid. But at the same time, these strategies are being presented. So, and I think the results are, I would say, they're pretty much meaningless given the test bed here, because yeah, only 100 trades I think is too small, and I will say more in detail later. And then the length of the test in this case is 14 months. I consider this also to be very small, because it's pretty much 1 year. You can have like a very good year. An algorithm will work great for 1 year, but it can be disastrous for the next year or the previous year. So it's really important to have multiple years every time, not just once. And then on a positive note, yeah, the risk per trade is only 2%. It's I'd say rather small. I think it really depends on the kind of market, but I think this is very good and acceptable. But the another big issue is really at the end. We're judging the algorithm by the profit, but there is no mention about the maximum drawdown. There's no mention of the volatility of this profit. So then again, with only 100 trades, it's probably been handpicked for a specific period. So, but at the same time, profit, one should steer away from just judging by the profit by itself. Now, personally, I prefer profit divided maximum drawdown. There is other ways of doing it, but there is also Sharpe ratio. There's a bunch of things. There's what SQN, which is close to statistical error based on standard deviance and things like that. But yeah, so and all these tests, they're pretty much along the same line. In this case, this one is on multiple markets, but I think it was only a couple of markets and only for 3 months. That's basically nothing. You can pick any 3 months and have a very good result or have a terrible result. And again, 100 trades, and that's the profit. Another thing that I guess it seems that there's a take profit mechanism. I'm personally also against this. The idea of doing a take profit, having what is it called? The ratio between the acceptable reward and risk preset. I don't think that's a good way of optimizing an algorithm, because you always want to take as much profit as you want, not just a predetermined set based on your risk per trade. Yeah, basically they're similar, like 15 months, but yeah, too short. And so now, pretty much looking at the list that I previously made, we can see that yeah, in general, they pretty much all have, I would say, relatively short time span for testing, and definitely a small number of samples. And ignoring trading fees, which on 100 trades maybe is not that big, but it can accumulate. I mean, if you on 100 trades, that's probably 100 positions. So I don't know, if you have a 0.1% trading fees, you multiply by 100 is by 200 maybe positions. That's 20% that takes away. And plus, one should also consider the slippage. So definitely no excessive stop loss. 2% is great. Overly complicated algorithm, it really depends on the strategy that is presented on a video per video basis. And analyzing, evaluating algorithm just by profit or mostly by profit, yeah, that's another scene there. And one that I didn't mention, a system with no variability, that's also the case. Yeah, one strategy, but the parameters never change. Of course, that's something that means, I mean, that goes beyond the strategy. There has to be a strategy selector and a portfolio management, ideally. But nevertheless, this is a system that doesn't have any variability. So by definition, this is pure backtesting without walk forward analysis. So that's also another, I think, a big minus point to the validity of those tests. So a little bit about why I consider 100 trades not enough, because I think empirically everybody will tell you that, or most people will tell you that. At the practical level, I would like to reason why I consider 100 trades not enough, and I think they should be in the thousands. So first, I think it's important to have multi-year testing. That way you can first, I mean, you have to at least have 1 year to capture monthly performance and also quarterly performance. And that way you can establish an expectation on how many possibly negative months or positive months you have. And of course, you want to do that for multiple years, because different years can have a completely different type of market. It depends on whatever is the issue of that instrument, or whatever is the issue with the world at any given time. So definitely, I would say, I mean, as many years as possible. Then there could be reasoning for maybe excluding years that are too old and relative new markets, but ideally one wants to have at least, I don't know, 3-4 years, but definitely not 1 or a few months. And this is just basically the logical basis for having a multi-year testing. And then another thing is, I think to have a system that is really robust, one should be able to test on different markets, maybe not completely different if the system is not dynamic, But for example, if something works on Bitcoin, does it also work on Ethereum? If it does much worse, then it could be a red flag, and it could be highlighting, or maybe not highlighting, hiding actually some flaw. So it may be worth looking into it. Why does it work so well on Bitcoin? Why doesn't it work well on Ethereum or Ripple? And then if it does good, also ask why, because it's possible the one is testing markets that have too much correlation. So this year, for example, maybe Bitcoin and Ethereum aren't showing that much correlation. I mean, but in the past they may have shown more correlation. So make sure also that there isn't too much correlation. But that's kind of arbitrary, but that's a basic idea. So, and the alternative to this would be perhaps to generate your own market data given a certain history of a single market data, which is something that I've seen proposed. Like, for example, you take 3 years of Bitcoin and then kind of randomly generate, permutate section of the market so that you can generate an additional year, which is not a real market, but is plausible. But I kind of have an issue with that, because how do you actually generate that? Because there's many ways you can operate at many different frequencies. How do you know that you're really generating something that is plausible or not? So for this reason, I'd rather go with similar markets and test also on similar markets. So given that one should do multiple years, because there can be different years can be completely different for each market, and then also do different markets. Let's say that we take 3 years for 3 markets, which I would say is the very minimum. That will make 108 months, and that means that you pretty much have 1 trade per month. And the problem here is that it's very low frequency, so you only have 1 trade per 1 month. You can really judge on a monthly basis, and that's already out of the window. If you cannot judge on a monthly basis, how do you know when your system is starting to degrade, severely degrade? I mean, you will eventually find out, but it's going to take several months. So your ability to correct the system is extremely lagged. So that's the big problem, and that's why I think if you take these assumptions that you need at least a certain number of markets, a certain number of years, then you need at least enough, more than multiple trades per month, so that you can also judge on a monthly, possibly on a weekly basis, what the back test does. And yeah, that's pretty much, I guess, what I wanted to say about all this. Yeah, this is definitely not the way to do back testing. I mean, sorry to be a naysayer, but I think I hope that this can be also considered as a constructive criticism. And until next time, thank you for listening.